Welcome to Module 12, further discussion of cost concepts. Management accountants can help managers with inventory valuation, product costing, costing of services, because it's very important to know how much it costs the company to provide a service or make a product, product pricing, break-even analysis. It's important to know how much you got to sell just to break even, product line profitability analysis. This is very important because it's happening right now. Decisions to downsize departments and lay off people. Well, now you know, when a manager or CEO makes that decision, the information is provided by, guess who? The management accountant. Decisions to discontinue a product or product line, preparation of budgets, and finally, forecasting. When I say forecasting, I mean forecasting of sales and expenditures. To help make these decisions, we use the following cost concepts. The concepts you need to know are product cost, period cost, variable cost, fixed cost, semi-variable or mixed cost, prime cost, conversion cost. And of these, if you remember from the previous module, we covered product cost, we covered period cost, we covered variable cost, we covered fixed cost, we covered semi-variable or mixed cost. We haven't done prime cost or conversion cost yet. We'll do that in this module. The other costs you need to know are relevant cost, opportunity cost, sunk cost, marginal cost, marginal revenue. Of these, in our previous module, we covered relevant cost, opportunity cost, sunk cost, which leaves marginal cost and marginal revenue, which we'll cover in this module. Let's talk about the cost concepts that we discussed. The cost concepts that up to now we haven't discussed are prime and conversion cost. Actually, it's really easy. What costs go into making a product in a factory? You got direct material. Do you remember that from the previous module? You got direct labor. You got overhead. Direct labor and overhead combined is called a name. It's called conversion cost. So prime cost is direct material plus direct labor. Conversion cost is direct labor plus overhead. That was easy, right? Now, we have only two more cost concepts to do. They are marginal cost and marginal revenue. Marginal revenue. The definition is it's the incremental revenue, that's the additional revenue generated by selling one additional unit. So, for example, see below. In this case, tell me what's the marginal revenue as you sell each unit. The marginal revenue is, when you sell the first unit, it's $50. When you sell the second unit, the incremental revenue is $45. When you sell the third unit, the incremental revenue is $25. And when you sell the fourth unit, the additional or incremental revenue, which is also called marginal revenue, is $24. Now, if you draw a graph, it's been proved that marginal revenue decreases as you sell each additional unit. So if you draw a graph, it'll look like this. That's marginal revenue. Why does it decrease? Because every time you sell more units, you got to work harder. Maybe you got to promote the product more. You got to offer higher discounts. So as you try to keep selling more units, the incremental or additional revenue decreases. Now, let's discuss marginal costs. The definition is the incremental or additional cost associated with making an additional unit. So, for example, see below. What are the marginal costs as we make more units? Well, when you make the first unit, it's 100. When you make the second unit, the additional cost is $80. When you make the third unit, 75. The fourth unit, 45. Marginal cost decreases as we make more units. Do you know why? This is because of a concept in economics called economies of scale. As you produce more, the cost gets distributed over a larger number of units. So the unit cost declines. So it looks like this. Marginal cost declines initially. But at some point, the company has to buy more machinery. They got to add more people to its workforce if they want to expand output. So after a certain output, marginal cost will increase. So initially it decreases, then because you got to buy more machinery, you got to add more people to your workforce, it goes up. Why are the concepts of marginal revenue and marginal cost important? It's important because it helps the company answer the following question. At what level of output can we maximize profit? Let me repeat that. It's important because it helps the company answer the question, at what level of output can we maximize profit? Let's go through the graph one more time. Marginal revenue looks like this. As I told you before, it decreases. That's marginal revenue. Marginal cost, after a certain point, looks like this. As I told you, it increases. Okay. Let's look at the left side. When marginal revenue is greater than marginal cost on the left, it means you can increase profit by producing more units because the additional revenue is greater than the additional cost. If you look at the right side, where marginal cost is greater than marginal revenue, at this point, don't make any more because you lose money. For each additional unit, the cost is greater than the additional revenue. So, at what point do we maximize profit? It's proved mathematically, it's the point where MR equals MC. So, let's summarize. When marginal revenue is greater than marginal cost, keep producing. When marginal cost is greater than marginal revenue, don't produce. So what's the optimum point? To maximize profit, the optimum level of output is where marginal revenue equals marginal cost. Now, let's look at a problem. I want you to take a few minutes and read this problem. If you want, stop this recording and print it out. Okay, let's go. I've given you the total costs, and this is what's required. A, prepare a table showing how the marginal cost of sorting machines varies with the number of machines manufactured. Part B, tell me why the marginal cost increases after 6 machines. Part C, tell me what's the average cost of making 5 sorting machines. Part D, if a sorting machine can be sold for $70,000, how many machines should be produced if the objective is to maximize profit? If you want, why don't you print this out, stop this recording, try the problem, and start after you're done. Stop now. Okay, are you done trying the problem? Let's do part A. Let's do a table showing marginal cost. It'll look like this. That's the total cost. For 1, it's 100,000, 2, 150, 3, 190. And I copied this from the table. So the marginal cost would be, for the first unit, it's 100,000. For the second unit, 50,000. For the third unit, 40,000, and so on. Why does marginal cost increase after 6 machines? Think about it. Because the company may have to purchase more equipment, they got to hire more people, and so on. So at a certain point, as I told you before, marginal cost increases. Part C, what's the average cost at 5 machines? The average cost is the total cost over number of machines, which is 250,000 divided by 5, which is 50,000. Now, let's do the most important, which is Part D. At what level do we maximize profit? If you're the boss, how many machines would you recommend they make? Let's put in a diagram for marginal revenue, then marginal cost. We know the total revenue. It's $70,000 a machine. So if it's 1, the revenue is 70. 2, at 70,000 each, 140. 3, 70,000 each, 210. 4, 70,000 each, 280, and so on. So the marginal revenue in this case doesn't change. For the first unit, it's 70. The difference between the second unit and the first unit is 70. The difference between the third unit and second unit is 70. So the marginal revenue in this example is 70,000 right across the board. Now, let's bring in marginal cost. We already did that. Take a few minutes and tell me at what number would the company maximize profit? What's the optimal output? Let's do it step by step. How about making 1 unit? Not a good idea, because the marginal revenue is 70,000, but the marginal cost is 100,000. So the cost, the additional cost, is greater than additional revenue. 2 units? It could work because the incremental revenue is 70,000. The incremental cost is 50,000. So the revenue is greater than cost. 3 units could work. Marginal revenue greater than marginal cost. 4 units will work. 5 units works. 6 units works. 7 works. 8 unit still works, because if you look, the incremental revenue is 70,000, but the additional cost is 60. 9 units? No. The cost is greater than revenue. So, at what point do we maximize profit? It's the point where MR comes very close to MC, which is 8 units. So the answer to this question is, to maximize profits, make 8 machines. Do you want to prove it? Okay. At 8 machines, what's the revenue? It's 560,000. At 8 machines, what's the total cost? If you look at your total cost chart, it's 400,000. So the profit is 560 revenue minus 400,000 cost equals 160,000. Choose any other number, your profit will be less than 160,000. For example, let's take 6 machines. At 6 machines, the revenue is 420,000 in total. What's the total cost at 6 machines? 280,000. So what's the profit? 140,000. So it's less. So the answer here is the point where MR comes very close to MC is 8 units. At 9, MC is greater than MR. So let me recapitulate. The concepts of marginal revenue and marginal cost are used to figure out the optimum level of output for the company. The concepts which we discussed before, product cost, period cost, prime cost, conversion cost, they're all used for inventory valuation, product pricing, and preparation of financial statements. Let's now consider 2 other costs that we discussed before, namely variable cost and fixed cost. These are primarily used for forecasting. Knowledge of variable cost and fixed cost are used for forecasting of expenses. Why is forecasting important? Well, in today's environment, you need to be able to forecast how much you'll spend so you know how to get the money beforehand. Okay, let me ask you a basic question. Look at the table coming up. If you know a cost is variable, is it easy to forecast or difficult to forecast? If you know a cost is fixed, is it easy to forecast or difficult to forecast? If a cost is mixed, which means it's got both variable and fixed, is it easy to forecast or difficult to forecast? Okay, if a cost is variable, the answer is it's easy to forecast. Why? For example, let's say you know something costs $10 per unit. Then the cost of making 1 unit is $10, 2 units is $20, 3 units is $30, and so on. So it's easy to forecast. How about if you know that a cost is fixed? Easy to forecast because a fixed cost, like rent by definition, doesn't change. If you know a cost is mixed, is it easy or is it difficult? The answer is it's difficult. This is because you really don't know how it's going to move. In real life, most costs are mixed. So, here are the steps to forecasting. The steps in forecasting are, number 1, break down mixed costs into variable and fixed elements. Let me repeat. If a cost is mixed, find out how much is variable and how much is fixed. To do this, actually there are many techniques. These include something called account classification method, something called high-low method, something called regression method, and another technique called scatter graph. In this course, the only technique you need to know is the high-low. So, how does the high-low work? I'm going to give you a really simple problem. Take a few minutes and read the problem coming up. Laura Bow has been operating a dental practice, and she's got information from May to December. And you can see the patients served, and you can see the total costs. The questions based on this information are: compute the total fixed cost and variable cost per patient, number 1. Number 2, calculate the predicted cost of dental hygiene services if, for example, she serviced 770 patients. Calculate the predicted cost if she serviced, for example, 450 patients. Take a few minutes and print this out. Then we're going to discuss this together. How does the high-low work? The first step is to take 2 readings, take 2 activities. You look for the highest activity and the lowest activity. In this case, what's the highest activity when she services 720 patients? What's the lowest activity when she treats 200 patients? The second step is for each activity, the high and the low, find out the related cost. What's the cost of serving 720 patients? 4,500. What's the cost of treating 200 patients? 1,900. So that's the first step in high-low. Take the highest activity and find out the cost. Take the lowest activity and get the related cost. The next step is get the difference. So for a change of 520 patients, the cost changed by $2,600. Only variable cost changes with an activity. If this was a pure fixed cost, it wouldn't change. Let me repeat, only variable cost changes with an activity. So the variable cost is $2,600 for a change of 520 patients. Variable cost is $2,600 for 520 patients. So the variable cost per patient, if you divide it, it's $5. Now, how do you find out the fixed cost? Use the formula. Total cost equals fixed cost plus variable cost. Choose the high month or the low month. You should get the same answer. So, in our example, let's use the low month. The total cost, 1,900, equals fixed cost. You don't know it, so take it as X, plus variable cost. At that level, it's 200 patients, and you know it's $5 per patient. So 1,900 is the fixed cost plus the variable cost is 1,000. So if you solve, what's the fixed cost? 900. To prove it, let's take the high month and see if you get the same answer. Go back again. Total cost equals fixed cost plus variable cost. The cost was 4,500 equals fixed cost, take it as X, plus variable cost. At that level, it was 720 patients, and our variable cost was $5 per patient. So total cost of 4,500 is fixed cost, take as X, plus the variable cost, which is 3,600. Solve for X, 900. So the fixed cost for Laura is $900 and the variable cost is $500 per patient. Using that, we can come up with a cost formula. The cost formula is total cost equals fixed cost, which is $900, plus variable cost per unit, per patient here, which is $5, times X. In this formula, fixed cost is $900, variable cost is $5 per patient, and X is number of patients. So now, if somebody asked you, what's the cost of treating a certain number of patients, you just plug in for X. So, as in our example, for 770 patients, just plug in X. So total cost is 900 plus 5 times 770, which is 4,750.